Hey everyone, welcome to our series on options trading. I'm Ryan Victorin, Vice President Financial Consultant here at Fidelity Investments, and I'll admit it, I used to be super intimidated by options for the longest time. But believe me when I say we are going to break everything down for you and make learning about them as quick and simple as possible, so that by the end of this series, I hope you'll feel confident enough to start trading options on your own. Okay, before we begin, I want to give you a quick overview of what we'll be talking about. First, we'll discuss who options might be right for. Then we'll take a deep dive into what an options contract actually is. And finally, we'll compare trading options with buying stocks. So, who should consider trading options? People typically trade options for three main reasons. 1, to use less upfront cash to take advantage of market moves and potentially enhance returns. 2, to generate income. And 3, to manage risk by reducing the potential downside they could face in an underlying investment, such as a stock, an ETF, or even an entire investment mix. That said, options can also be appropriate for someone who wants to take on a little more risk for potential greater returns. And there's a lot to learn about options in general, so if you're inexperienced, I'd suggest not touching them until you've educated yourself a bit more to decide whether they're right for you in helping meet your investment objectives. And watching this series is a great place to start. Now we've covered common reasons why someone might trade options. Let's talk about what an options contract actually is. An options contract is an agreement between a buyer and a seller to trade an underlying investment, which is usually a stock or an ETF. Each option includes a specific price and lasts for a set time period, and typically covers 100 shares. The options buyer pays for the right to buy or sell those shares. And in the options world, the price of an options contract is called a premium. So for example, the buyer might pay a premium for the right to buy 100 shares of a stock at the price of their choosing up until the contract's expiration date. The price that the buyer and seller agree on is called the strike price. The buyer and seller also agree on how long the contract is good for, which sets the expiration date. So what does this look like when you pull it all together? Say you have strong feelings about the prospects of a famous shoe company over the next few months. You could buy an options contract that gives you the right to buy or sell 100 shares of the shoe company's stock at the price you want anytime before the date you choose for the contract to expire. And if the stock hits your desired price and you decide to buy or sell those shares, that's called exercising the option. So let's take a look at the other side of the agreement, which is when you're selling an options contract. As the options seller, you take on the obligation to buy or sell those 100 shares at the agreed upon strike price if the buyer chooses to exercise before the contract's expiration date. In exchange for taking on that obligation, you get paid the premium. And in other words, you get cash in your account for selling the contract. Now, let's talk a little bit about the difference between stocks and options, and they both have unique characteristics. Stocks give you an ownership stake in a company, meaning you may receive voting rights, potential dividends, and a lower break-even. In other words, you could start gaining as soon as the stock starts moving upwards. Stocks require you to put down more cash to buy shares directly, compared with options contracts, which gives you the right to control those shares for less money up front. There are also limited trading strategies. You can either buy a stock or sell it short. Let's contrast that with buying options, which requires less cash up front for the opportunity to take advantage of market moves. You can get exposure to potential gains while limiting risk to the amount of money you paid for the premium. Options also offer a lot of different strategies. So many that you might have heard the phrase, options give you options. It may sound corny, but it's very true. There are options trading strategies that let you profit from the stock going up, going down, and even not moving. Unlike stocks, options don't grant you immediate ownership stake in a company, meaning you don't have voting rights and you aren't eligible to receive dividends. And in some option strategies, you could have a higher break even, meaning that to profit, you need the stock's price to move more than if you just bought the stock outright. So that's a quick overview of what options are, why people typically get into options trading, and how it's different from buying or selling stocks outright. Hopefully after this first video, you're already feeling more comfortable with options, but we're just getting started. We're going to keep breaking down the details for you in this video series. Next up, we'll introduce you to 2 types of options and explain the 4 actions that are the building blocks for all options trading strategies. In the meantime, if you have any questions, please drop them in the comments section below. So, thanks for watching and see you next time.